Hello and greetings, everyone. I hope everybody's having a fantastic day today. Welcome to the Bull Runners community. In today's video, I want to discuss the burning topic, which is Bitcoin ETFs. Just want to give us a highlight, an update, and a great overview so that we have a better understanding of what's going on. Before we get into the news, let's look at the market. Right now, we're at 1.55 trillion. We are down 1.68% for the day. Bitcoin is back below 42K. As we see, it's at 41,600. So is Ethereum. It's at 2,167. And as we know, this market is heavily dictated by emotions, mainly fear and greed. Coupled with the lack of liquidity in the industry, this causes for high volatilities, of course. Now, with that said, let's get into today's news. Today's news discusses how the SEC is unlikely to approve Blackrock's Bitcoin spot ETFs in its current form. Right now, we know that Blackrock has a very great track record. They have over 500 applications made for their ETFs, and only one has been rejected so far. So they have a solid track record. So the whole market anticipates that if anybody gets it, then it's BlackRock. So how come the SEC, it's unlikely to approve BlackRock's ETF? This is because the Securities and Exchange Commission focuses more on cash-centric approach to the ETFs. What does that mean? The SEC is concerned over potential market manipulation and arbitrage opportunities that is associated with the in-kind redemptions. Now, let's understand what is in-kind redemption and what are cash redemptions. So the cash creation model involves the authorized participants depositing cash equivalent to the asset value in the creation units. Now, the fund then uses this cash deposited to purchase the underlying asset, such as Bitcoin, since it's a Bitcoin ETF. In contrast, the in-kind creation model allows participants to deposit a basket of securities that match the ETF's portfolio. This eliminates the need that the fund will be forced to sell securities for cash immediately. Now, why is BlackRock and its counterparties, competitors, which is Vanguard, UBS, Fidelity, all these asset managers, why are they so wild on using the in-kind? Why do they want to use the basket of securities? Because they're already in the real world. They already have 43 trillion worth of assets under management. So for them, they already have assets. It's easier for them to just use these assets as collateral. And this is exactly what they did. Like if you see here, let's go up here. This is why JP Morgan and BlackRock, they're focusing so heavily on tokenizing BlackRock's shares. As we know and as we saw here, BlackRock is the leader as far as asset managers. They have the most money market funds. It's 9.1 trillion, they alone. So they're the market leaders in the industry. And why reinvent the wheel if you can just use your assets that you already have, tokenize them, then use the shares as collateral? So they already carried out their first live blockchain-based collateral settlement transaction. JP Morgan's has an Ethereum-based blockchain, as we know, and they used the bank's tokenized collateral network, which was used by BlackRock to tokenize their shares, the money market funds. And these will be used for collateral for an over-the-counter transaction. They call it the derivatives trade, meaning you derive value from an underlying asset. In this case, it's their money market funds that they're collateralizing. They're lacking liquidity, so they have to get funds from somewhere, liquidity from somewhere. And this is why they're using the existing money market funds. And they want to collateralize them by tokenizing those money market funds, bring them on-chain, and then use the funds to purchase Bitcoin over the counter, like we see. So this is exactly what's been happening. So these large institutions, they buy large amounts over the counter. And why are they doing that? The high fees, the high transaction fees, and limited supply in Bitcoin on the regular exchanges, these are limitations for whales and institutions. Lack of liquidity, there's not enough supply on the Bitcoin exchanges, and the high fees. These big investors and institutions, they want to stay under the radar, and they don't want to drastically affect Bitcoin's price whenever they have a large buy order. So this is why they use over-the-counter. To participate in over-the-counter, you have to have at least 100,000 in order to participate. Now, let's look at over-the-counter. What are the pros and the cons? Like we said, there's two main ways to buy Bitcoin, and that's over-the-counter through brokers, like we say, but you have to be a whale, like a large investor or an institution. You have to meet a certain criteria. Usually, like we saw, it's 100,000 and above. And there's also the traditional way, of course. And you can either buy through the broker, which is the company or individual willing to sell your Bitcoin directly, as opposed to automated trading platform. So over the counter is you have big whales willing to sell their Bitcoins to you directly, and you avoid the high fees, being exposed. Nobody will know exactly who made these trades. So now, what are the benefits of over-the-counter? Of course, like we said, it's the high liquidity, okay? So over-the-counter brokers specialize in supplying high volumes of Bitcoin to large buyers such as institutional investors, and they want to also be anonymous. So this means that most of the time you will be able to get your order fulfilled faster than in traditional exchanges, because now you're dealing with the sellers directly. So buyers and sellers are put together. So another thing is a fixed price. So this is new to us. Usually in a traditional trading way, whenever a purchase, a buy is made, the price increases. So these whales and institutional investors, of course, they don't want that. They want to be able to purchase like $1 billion worth of Bitcoin without affecting the price heavily. So this is why they can negotiate a fixed price for the entire order, for example. And this is due to the fact that they can buy cheap from the sellers and then sell expensive to the buyers. That's the whole idea. Buy cheap in a bulk and then dump it on the market, on the retailers at a higher price. Let's look at the disadvantages, okay? So the disadvantages of over-the-counter, of course, are less transparency. And this is exactly why the institutions were hesitant of giving green light to these ETFs, spot ETFs, because lack of transparency. While on a traditional trading platform, the order book is transparent for everyone to see. When buying over the counter, you don't always know exactly who you're dealing with and the volume that they have to trade. You are basing your information solely on what you get from the seller. And then, of course, less regulation. And this is exactly what the regulators are hesitant about and want to bring more clarity, more transparency, more regulation. So there's over-the-counter means there's less regulation involved, since many of the OTC sellers, they aren't even listed as money transmitters. So they don't even have licenses. So the risk is here and increases with these transactions. And this is also the reason why you see these large institutions such as Kraken or Binance, which just settled for $4.3 billion with the DOJ, Department of Justice, or Kraken. They've all been sued for money laundering, bank fraud, violating the US sanctions laws, and so on and so forth, because most of them don't have any licenses to operate in these various regions. They've been commingling up to $33 billion worth of funds in customers' crypto with its own corporate assets. So these are the reasons why regulators are hesitant with the over-the-counter institutions. So, but why is BlackRock and its competitors so wild about using collateral? It's because it's risk-free. If you can use your existing assets from your money market fund, which is only by the top 10 already, it's $43.4 trillion US dollars. You don't have to use your own cash. You can just use these as collateral, and they already paved the way for this. They already went through tests successfully, and they are already using their money market funds as collateral. This is how they use the money market funds as collateral, raised liquidity, and purchased their Bitcoin very cheap, negotiated the price, as we saw here, over the counter, and got it in bulk very early on. So they did their bidding already. Now, this is where regulators are very hesitant about, because they want BlackRock and its competitors to be liquid. First of all, it's in their best interest because they want to be able to tax those transactions as well. They want to cash in as well. But if BlackRock and its competitors are allowed to use their money market funds as collateral, which is, like we saw, 43.3 trillion, there you don't pay taxes on credit. So they would go tax-free. So BlackRock and its competitors are working in the best interest of their clients and themselves. This is how the wealthy do. They just take a loan against their assets, and then you can't charge taxes on loans. And this is why the SEC is unlikely to approve BlackRock's ETF, because they want to use the collateralized version of it. And they already went through a successful tokenized shares. They already went through a successful transaction, like we see here, using their tokenized collateral network, and sent it to Barclay for collateral for an over-the-counter derivatives trade, which they did here. And this is how they purchased Bitcoin. This is very dangerous because this is how Genesis, for example, it filed bankruptcy now. Genesis also was hit by the collapse of Three Arrows, because Three Arrows Capital had owed them $1.2 billion worth. So borrowing money or leveraging money can have a ripple effect. And this is how Genesis, now that they're filing bankruptcies, because Three Arrows, which borrowed money from them, and in as high as 1.2 billion, couldn't pay it back because they also invested their money or clients' money into Luna, which also collapsed. So it's a ripple effect. And this is the same concept that BlackRock and its competitors are trying to do. They're trying to use the existing funds from the money market funds. They want to use part of that to raise funds and use these as collateral without selling the money market funds already. This way, they can save their clients tax money and for themselves as well. And they can just leverage what they already have and raise liquidity that way. But this is where the SEC comes in and says, no, this is not how it's going to be done. For us to approve your ETFs, Bitcoin spot ETFs, you have to use cash, meaning you'll have to literally liquidate the securities, get the cash from the authorized participants, and then use that cash in real time and then purchase the underlying asset, Bitcoin, on the market with it. And as we know, these large institutions, they know better. They're not going to risk their clients' funds because they understand that Bitcoin has a major issue. And Bitcoin's major issue is that Bitcoin is going through a liquidity crisis. It's been going through a liquidity crisis for a very long time. Bitcoin has a very horrible liquidity to market cap ratio. And because Bitcoin has a bad liquidity to market cap ratio, many of these asset managers are not going to want to liquidate the existing assets under management to purchase a risk asset that is volatile and that lacks liquidity. And this is where they have these constant meetings back and forth trying to find a middle way. But the SEC say, no, there's no way we're going to allow that. You would have to use the deposited cash equivalent for that specific amount of Bitcoin, and then you have to go on the market and purchase it at the current price. So if you think about it, ETFs are the only people who purchase the ETFs are the asset managers themselves, okay? And the holders are just holding a paper. They don't have the physical Bitcoin with them. The custodians will be Coinbase, of course. So Coinbase will be the custodians, and the asset managers will be the ones holding the real Bitcoin. The clients who are using these asset managers will just be holding a paper stating that, okay, you purchased X amount of Bitcoin and this is what you have. So because these asset managers already went ahead, collateralized their existing assets, used that liquidity to purchase Bitcoin over the counter at a very low negotiated price outside of the exchanges. Now they want to profit two times. They want to profit from the increase of the price, and then they want to profit from the transaction fees, of course, as well. And this is where it really gets tricky, because now majority of traffic is going to go towards these ETF providers, spot ETFs providers, like we saw here, because they're trading fees. The way centralized exchanges stay sustained is through trading volume, okay? And right now, the way it looks is that the ETFs, they're catering towards those who have 100,000 and above. They cater more towards institutions, and this is the whole idea. So what's going to happen here is you'll see a lot of institutions and even retailers, depending on their portfolio size, they'll be able to purchase or trade Bitcoin at a interest rate of 0.01. This is extremely low compared to the centralized exchanges such as Coinbase, which charge 0.6% for trade. Centralized exchanges are really going to lose out once these spot ETFs are being approved, and they'll really lose out on market share. And now with the SEC and the DOJ on their backs monitoring, especially Binance, not only did they pay the $4 billion in fees, but they also agreed that the DOJ will be monitoring them for the next 5 years. So they'll have to be compliant and play by the rules, and so are the other centralized exchanges as well. So with them being monitored, of course, they'll have to play by the book. And with that said, they'll be losing out on a lot of fees, because these asset managers are charging a 0.01 in trading fee compared to a 0.6%, which is obviously way more. So this will really wipe out a lot of centralized exchanges, as they will be losing out on market share as far as trading volume is concerned. This is where now the retailers are back to suffering again. You see how right now people claim that the SEC, this is what a typical SEC meeting looks like. SEC, they're a bunch of clowns and so on and so forth. However, if it wasn't for the SEC insisting that these asset managers have to deal with cash before their ETFs will be approved, the retailers will be even in more trouble, because this means that the retailers will be voluntarily being the exit liquidity for all these large institutions and whales, because they are not trading Bitcoin on centralized exchanges. Retailers do, because in order to participate, you have to have at least 100,000, like we saw here. You need at least 100,000 to participate. So these will be only for big whales and institutions. Regular folks, retailers, they'll be using centralized exchanges or decentralized exchanges, and that's where the liquidity will be in. Majority, of course, will still be using centralized exchanges. Like I said, Bitcoin is going through a liquidity crisis. It doesn't have enough liquidity. There are 6 Bitcoin billionaires and 78 so-called centimillionaires. That means they have 100 million and above, 78 of them. And then they have 6 billionaires, right? Bitcoin billionaires. Now, if we look at Bitcoin's liquidity right now, it's at 890 million. So it just takes one billionaire to change his mind or to reallocate his assets and in his portfolio, and he will wipe out entire liquidity out of Bitcoin. Or it will just take a handful of so-called centimillionaires. There's 78 of them, like we identified here, with a portfolio of 100 million and above, and this will heavily affect the liquidity of Bitcoin. And with that said, this is the reason why you see here Bitcoin is really suffering from a liquidity crisis. These asset managers and asset companies, they know that. This is why they purchase over the counter. They're not playing with small amounts. These are $43.4 trillion. So even just 1% of this is already 430 billion. And as we saw, Bitcoin, that represents half of the entire liquidity of Bitcoin. And this, of course, over the long term, will cause these asset managers to purchase Bitcoin at higher prices. And as they keep purchasing Bitcoin, of course, the price will keep increasing. And eventually, they'll be at a loss. And they'll also be risking their clients' funds because the illiquidity of Bitcoin. And this will put them in harm's way. And this is what they've been trying to avoid in the first place. So the SEC is putting them in a corner where they won't be able to be compliant with the cash only way that the SEC is requiring them. I hope it made sense to you and you have a better understanding of what's going on in the market right now. So the losers, as always, will be retailers. As you see right now, it's strictly buy the rumor, sell the news. And as we understand, during a bull market, you need to understand something. These institutions, they're not using their funds. Retailers are selling their homes, their cars, life savings. They're all throwing it in here into Bitcoin. Meanwhile, Blackrock and its competitors, they're actually not using their money. They're just using the funds that they have as collateral, raising liquidity, purchasing over-the-counter Bitcoin at a very low price. So they're already way ahead because they started purchasing Bitcoin a year, 2 years, 3 years ago. And Fidelity is actually even mining Bitcoin. They're one of the larger mining companies that they're also mining Bitcoin. So they got Bitcoin extremely cheap. This is what's happening right now. And this is what the SEC wants to avoid, that these large institutions take advantage of retailers by actually avoiding going through the open exchange markets and going through the OTC that is unregulated, not transparent, and avoiding adding liquidity to an already illiquid asset, which is Bitcoin, and that is going through a liquidity crisis, has been going through a liquidity crisis, and is in a liquidity crisis. Meanwhile, retailers are being told to go ahead and purchase Bitcoin, purchase it now before risk institutions come in. But keep in mind, these asset managers, they already bought Bitcoin. And if not, they're mining Bitcoin as well. So their purchasing is already done. And this is what the SEC wants them to start doing. They're like, no, we want you to buy also, like everybody else, purchase Bitcoin with the spot price, with the current price, using the cash given to you by the clients, by your investors. These are the contradictions that the two parties are facing right now. These amounts of funds, it will be a disaster because Bitcoin obviously is a very volatile and illiquid asset right now. And they're not going to want to risk their own funds or their clients' funds. It will tarnish their reputation. They'll be on the bad side of the SEC, and they will actually prove exactly what the SEC was talking about all along. And this is what even the CEO, Jamie Dimon, said, that the Feds should close down Bitcoin. And this is the agenda that they want to follow through and prove to the community, to the society, that yes, you see, this is why we say shut down Bitcoin, because it is illiquid, it is a very risky asset, and it will put the society, the investors, the retailers at a big risk. And now they want to use retailers as exit liquidity. And now they're just waiting because they also understand that after a boom, there'll come a bust. So obviously they'll sell on the top while everybody's frenzy and FOMOing in. That's when they really start taking profits, and they'll sell in the open market, because during a bear market, as the bear market is taking place, nobody will want to be buying Bitcoin. People will be wanting to sell it. And where will they come to sell it? On the open market. And this is the market where the retailers have been eagerly being the exit liquidity and pumping the price up for them. So this is what's going on in the real world. If you see Twitter or YouTube urging you to buy Bitcoin, go ahead and buy it before the institutions come in, they're misguiding you, because institutions already did their bidding, and they're not even using traditional exchanges such as the retailers are. They're doing over the counter like we saw, and they're dealing with much larger quantities. So those institutions will make big money using retailers as exit liquidity. So be aware, be informed, be alert, and understand what the market is doing, understand what's going on in the industry, be alert of these, and this is why we make these videos, to educate and inform you and to inspire you, and also to put you in high alert, to be careful, do your own research and make the right moves. Don't fall for all these hype crypto platforms that are just telling you to go blindly just buy, be an exit liquidity for Bitcoin, but understand exactly what's happening, why are these shifts happening, and understand what's going on in the market. With that said, I wish everybody a wonderful rest of their day, and see you next time.